Why is it that the world's wealthiest people never seem to have a large salary? Most of us ought to work hard, save money, and eventually pay off all our debts. But for the top 1%, debt is not a burden to be avoided. In fact, debt is the most powerful tool in their financial arsenal. They use a strategy so effective it allows them to live a life of luxury without paying a single cent in income tax. It is called the buy, borrow, die strategy. For decades, this method was reserved for billionaires and high net worth families. But today, the walls of the elite are coming down. If you are over the age of 55 and have built a significant portfolio, this could change everything. I am going to reveal how you can access hundreds of thousands of dollars in tax-free cash. You will learn how to keep your assets growing while spending the bank's money instead. This is not about tax evasion or doing anything illegal. This is about understanding the same financial architecture used by the giants of industry. Let us start by shattering a common myth about retirement. Most financial advisors tell you to sell your stocks and retirement assets to fund your lifestyle. But every time you sell, the government is standing there with its hand out. Capital gains taxes can swallow up to 20 or even 30% of your hard-earned growth. Imagine losing nearly a third of your wealth just because you needed the cash to live. The wealthy refuse to accept this as their only option. Instead of selling their empire, they build a fortress around it. The first pillar of this strategy is to buy. You must own assets that appreciate over time, such as high-quality stocks or real estate. In a world of high inflation, holding too much cash is a guaranteed way to lose purchasing power. Cash is a melting ice cube, but great companies and land are durable shields. Once you own these assets, you move to the second pillar, which is to borrow. This is where the magic of the securities-based line of credit comes into play. Some call this an SBLOC for short. It is a flexible line of credit that uses your investment portfolio as collateral. Think of it like a home equity line of credit, but for your stocks and bonds. Because you are not selling your shares, you do not trigger a taxable event. The bank simply looks at your portfolio and gives you a credit limit based on its value. If you have $1 million portfolio, a bank might let you borrow $300,000. You can use that money for anything from a new home to a dream vacation or daily expenses. The best part is that your $1 million stays invested in the market. It continues to earn dividends and it continues to grow in value over the long term. Often, the growth of your investments will be higher than the interest rate you pay the bank. This means you are essentially getting paid to spend money. Now, you might be wondering why the government allows this to happen. Under the laws of the Internal Revenue Service and the Canada Revenue Agency, a loan is not income. When you receive a paycheck, it is taxed. When you sell a stock for a profit, it is taxed. But when you take out a loan, it is considered a private contract between you and a lender. You could spend $10 million of borrowed money and owe $0 in income tax. This is the ultimate legal loophole that keeps the wealthy ahead of the curve. But the strategy does not end with just borrowing for today. The third and final pillar is the most important one, and it is called die. This sounds morbid, but in financial terms, it is a stroke of pure genius. In the United States, we have a rule called the step-up in basis. When you pass away and leave your stocks to your heirs, the cost basis is reset. It is reset to the current market value at the time of your death. This means all the capital gains taxes that built up over your lifetime simply vanish. Your children can sell the assets immediately and pay zero taxes on the growth you enjoyed. They can then use a portion of that tax-free inheritance to pay off the bank loan you took out. The debt is settled, the taxes are avoided, and the family legacy remains intact. This is how generational wealth is created and protected from the hands of the taxman. However, being a wealth architect requires more than just knowing the theory. It requires the discipline to manage risk in a volatile and changing world. The biggest danger to this strategy is a sudden market crash. If the value of your stocks drops too far, the bank will issue a margin call. They will demand that you pay back a portion of the loan immediately. If you cannot pay, they will sell your stocks at the bottom of the market. To avoid this, you must follow the 25-75 rule. Never borrow more than 25% of the total value of your portfolio. If you have $100,000, only borrow $25,000. This gives you a 75% cushion of safety against volatility. Even if the stock market drops by half tomorrow, your loan is still perfectly safe. You will never be forced to sell your assets during a market downturn. Another risk to consider is the current interest rate environment of 2025. When interest rates are high, the cost of your credit line goes up. You must ensure that the quality of your assets is high enough to outpace the interest. Focus on companies that pay consistent and growing dividends every year. Those dividends can often cover the interest payments on your loan automatically. Now, let us discuss how you can start implementing this architecture yourself. Step 1 is to perform a deep audit of your current asset quality. Are you holding speculative stocks or stable, dividend-paying blue-chip companies? The bank will give you better terms if your portfolio is diversified and safe. Step 2 is to choose the right lender for your specific needs. Major firms like Charles Schwab, Morgan Stanley, and Fidelity all offer these programs. Compare their interest rates and their required loan-to-value ratios carefully. Step 3 is to establish your line of credit before you actually need the cash. It costs nothing to have the credit line sitting there as a safety net. Think of it as your own private bank that you can access with the click of a button. Finally, step 4 is to create your legacy plan with a qualified professional. You must ensure your estate documents are updated to handle this step-up in basis. In Canada, the rules are slightly different due to the Deemed Disposition tax. Canadian residents must use life insurance to offset the tax bill at death. But the core principle remains the same for both nations. Do not sell your wealth to fund your life if you can borrow against it instead. Wealth is not measured by the cash in your bank account today. It is measured by the tax-free liquidity you can access without shrinking your empire. Most people spend their entire lives building a mountain of wealth, only to have the government take a massive peek off the top when they try to enjoy it. You do not have to be one of those people. You have the opportunity to architect a different kind of future. One where your assets work for you while you are alive and for your family when you are gone. Ask yourself this important question today. If you could access $100,000 from your portfolio tomorrow without taxes, what is the first legacy project you would fund for your family? Would you help a grandchild with college or buy the vacation home you always wanted? The choice is yours when you stop playing by the old rules of money. Before you take any action, please remember that I am not your personal financial advisor. This information is for educational purposes and reflects general market strategies. Borrowing against your assets carries significant risks, including the potential for loss. Always consult with a licensed tax professional or financial planner before making moves. Every financial situation is unique and requires a tailored approach. Your legacy is too important to leave to chance or a one-size-fits-all plan. Take the time to build your foundation correctly and with the right guidance. The world of the elite is no longer a closed door. You now have the blueprint to walk through it yourself. May your assets grow and your taxes remain at zero. Keep building, keep protecting, and keep looking forward. The best years of your financial life are still ahead of you. Thank you for your time and for your commitment to your financial future.